Identify the components of debt and equity financing. Defining debt. Debt is a way for firms to access capital for operations or investment with various terms and agreements for future repayment. Key points. A debt obligation is considered secured if creditors have recourse to the assets of the company on a proprietary basis or otherwise ahead of general claims against the company. Private debt comprises bank loan type obligations, whether senior or mezzanine. Public debt is a general definition covering all financial instruments that are freely tradable on a public exchange or over the counter, with few, if any, restrictions. A syndicated loan is a loan that is granted to companies that wish to borrow more money than any single lender is prepared to risk in a single loan, usually many millions of dollars. Key terms: coupon. Any interest payment made or due on a bond, debenture, or similar, no longer by a physical coupon. Unsecured debt. Unsecured debt comprises financial obligations where creditors do not have recourse to the assets of the borrower to satisfy their claims. Private debt. Private debt comprises bank loan type obligations, whether senior or mezzanine. Debt finance. A company uses various kinds of debt to finance its operations. The various types of debt can generally be categorized into secured and unsecured debt, private and public debt, syndicated and bilateral debt, and other types of debt that display one or more of the characteristics noted above. A debt obligation is considered secured if creditors have recourse to the assets of the company on a proprietary basis or otherwise ahead of general claims against the company. Unsecured debt comprises financial obligations where creditors do not have recourse to the assets of the borrower to satisfy their claims. Debt. A company uses various kinds of debt to finance its operations. Private debt comprises bank loan sorts of obligations, whether senior or mezzanine. Public debt is a general definition covering all financial instruments that are freely tradable on a public exchange or over the counter, with few, if any, restrictions. A basic loan or term loan is the simplest form of debt. It consists of an agreement to lend a fixed amount of money, called the principal sum, for a fixed period of time, with the amount to be repaid by a certain date. In commercial loans, interest, calculated as a percentage of the principal sum per year, will also have to be paid by that date, or may be paid periodically in the interval, such as annually or monthly. Such loans are also colloquially called bullet loans, particularly if there is only a single payment at the end, the bullet, without a stream of interest payments during the life of the loan. A syndicated loan is a loan that is granted to companies that wish to borrow more money than any single lender is prepared to risk in a single loan, usually many millions of dollars. In such a case, a syndicate of banks can each agree to put forward a portion of the principal sum. Loan syndication is a risk management tool that allows the lead banks underwriting the debt to reduce their risk and free up lending capacity. A bond is a debt security issued by certain institutions, such as companies and governments. A bond entitles the holder to repayment of the principal sum, plus interest. Bonds are issued to investors in a marketplace when an institution wishes to borrow money. Bonds have a fixed lifetime, usually a number of years, with long-term bonds, lasting over 30 years, being less common. At the end of the bond's life, the money should be repaid in full. Interest may be added to the end payment or can be paid in regular installments, also known as coupons, during the life of the bond. Bonds may be traded in bond markets and are widely used as relatively safe investments in comparison to equity. Lending to stable financial entities such as large companies or governments are often termed risk-free or low risk and made at a so-called risk-free interest rate. This is because the debt and interest are highly unlikely to be defaulted. A good example of such risk-free interest is a U.S. Treasury security. It yields the minimum return available in economics, but investors have the comfort of the almost certain expectation that the U.S. Treasury will not default on its debt. A risk-free rate is also commonly used in setting floating interest rates, which are usually calculated as the risk-free interest rate plus a bonus to the creditor based on the creditworthiness of the debtor. In other words, the risk of him or her defaulting and the creditor losing the debt. In reality, no lending is truly risk-free, but borrowers at this rate are considered the least likely to default. Debt allows people and organizations to do things that they would otherwise not be able or allowed to do. Commonly, people in industrialized nations use it to purchase houses, cars, and many other things too expensive to buy with cash on hand. Companies also use debt in many ways to leverage the investment made in their assets, leveraging the return on their equity. This leverage, the proportion of debt to equity, is considered important in determining the riskiness of an investment. The more debt per equity, the riskier. For both companies and individuals, this increased risk can lead to poor results, as the cost of servicing the debt can grow beyond the ability to pay due to either external events, income loss, or internal difficulties, poor management of resources. How debt financing works. Examples, costs, pros and cons. What is debt financing? Debt financing occurs when a firm raises money for working capital or capital expenditures by selling debt instruments to individuals and/or institutional investors. In return for lending the money, the individuals or institutions become creditors and receive a promise that the principal and interest on the debt will be repaid. The other way to raise capital in debt markets is to issue shares of stock in a public offering. This is called equity financing. KTAWOS. Debt financing occurs when a company raises money by selling debt instruments to investors. Debt financing is the opposite of equity financing, which entails issuing stock to raise money. Debt financing occurs. Debt financing occurs when a firm sells fixed income products, such as bonds, bills, or notes. Unlike equity financing, where the lenders receive stock, debt financing must be paid back. Small and new companies, especially, rely on debt financing to buy resources that will facilitate growth. How debt financing works. When a company needs money, there are three ways to obtain financing: sell equity, take on debt, or use some hybrid of the two. Equity represents an ownership stake in the company. It gives the shareholder a claim on future earnings, but does not need to be paid back. If a company goes bankrupt, equity holders are the last in line to receive money. A company can choose debt financing, which entails selling fixed income products, such as bonds, bills, or notes, to investors to obtain the capital needed to grow and expand its operations. When a company issues a bond, the investors that purchase the bond are lenders who are either retail or institutional investors that provide the company with debt financing. The amount of the investment loan, also known as the principal, must be paid back at some agreed date in the future. If the company goes bankrupt, lenders have a higher claim on any liquidated assets than shareholders. Special considerations. Cost of debt. A firm's capital. A firm's capital structure is made up of equity and debt. The cost of equity is the dividend payments to shareholders, and the cost of debt is the interest payment to bondholders. When a company issues debt, not only does it promise to repay the principal amount, it also promises to compensate its bondholders by making interest payments, known as coupon payments, to them annually. The interest rate paid on these debt instruments represents the cost of borrowing to the issuer. The sum of the cost of equity financing and debt financing is a company's cost of capital. The cost of capital represents the minimum return that a company must earn on its capital to satisfy its shareholders, creditors, and other providers of capital. A company's investment decisions relating to new projects and operations should always generate returns greater than the cost of capital. If a company's returns on its capital expenditures are below its cost of capital, the firm is not generating positive earnings for its investors. In this case, the company may need to reevaluate and rebalance its capital structure. The formula for the cost of debt financing is KD equals interest expense X. 1. Tax rate, where KD equals cost of debt. Since the interest on the debt is tax deductible in most cases, the interest expense is calculated on an after-tax basis to make it more comparable to the cost of equity as earnings on stocks are taxed. Measuring debt financing. One metric used to measure and compare how much of a company's capital is being financed with debt financing is the debt-to-equity ratio, D/E. For example, if total debt is $2 billion and total stockholders' equity is $10 billion, the D/E ratio is $2 billion/$10 billion equals 1/5 or 20%. This means for every $1 of debt financing, there is $5 of equity. In general, A low D/E ratio is preferable to a high one, although certain industries have a higher tolerance for debt than others. Both debt and equity can be found on the balance sheet statement. Creditors tend to look favorably on a low D/E ratio, which can increase the likelihood that a company can obtain funding in the future. Debt financing versus interest rates. Some investors in debt are only interested in principal protection, while others want a return in the form of interest. The rate of interest is determined by market rates and the creditworthiness of the borrower. Higher rates of interest imply a greater chance of default and therefore carry a higher level of risk. Higher interest rates help to compensate the borrower for the increased risk. In addition to paying interest, debt financing often requires the borrower to adhere to certain rules regarding financial performance. These rules are referred to as covenants. Debt financing can be difficult to obtain. However, for many companies, it provides funding at lower rates than equity financing, particularly in periods of historically low interest rates. Another advantage to debt financing is that the interest on the debt is tax deductible. Still, adding too much debt can increase the cost of capital, which reduces the present value of the company. Debt financing versus equity financing. The main difference between debt and equity financing is that equity financing provides extra working capital with no repayment obligation. Debt financing must be repaid. The company does not have to give up a portion of ownership in order to receive funds. Most companies use a combination of debt and equity financing. Companies choose debt or equity financing or both, depending on which type of funding is most easily accessible, the state of their cash flow, and the importance of maintaining ownership control. The D/E ratio shows how much financing is obtained through debt versus equity. Creditors tend to look favorably on a relatively low D/E ratio, which benefits the company if it needs to access additional debt financing in the future. Advantages and disadvantages of debt financing. One advantage of debt financing is that it allows a business to leverage a small amount of money into a much larger sum, enabling more rapid growth than might otherwise be possible. Another advantage is that the payments on the debt are generally tax deductible. Additionally, the company does not have to give up any ownership control, as is the case with equity financing. Because equity financing is a greater risk to the investor than debt financing is to the lender, debt financing is often less costly than equity financing. The main disadvantage of debt financing is that interest must be paid to lenders, which means that the amount paid will exceed the amount borrowed. Payments on debt must be made regardless of business revenue, and this can be particularly risky for smaller or newer businesses that have yet to establish a secure cash flow. Advantages of debt financing. Debt financing allows a business to leverage a small amount of capital to create growth. Debt payments are generally tax deductible. A company retains all ownership control. Debt financing is often less costly than equity financing. Disadvantages of debt financing. Interest must be paid to lenders. Payments on debt must be made regardless of business revenue. Debt financing can be risky for businesses with inconsistent cash flow. Debt financing FAQs. What are examples of debt financing? Debt financing includes bank loans, loans from family and friends, government-backed loans, such as SBA loans, lines of credit, credit cards, mortgages, and equipment loans. What are the types of debt financing? Debt financing can be in the form of installment loans, revolving loans, and cash flow loans. Installment loans have set repayment terms and monthly payments. The loan amount is received as a lump sum payment upfront. These loans can be secured or unsecured. Revolving loans provide access to an ongoing line of credit that a borrower can use, repay, and repeat. Credit cards are an example of revolving loans. Cash flow loans provide a lump sum payment from the lender. Payments on the loan are made as the borrower earns the revenue used to secure the loan. Merchant cash advances and invoice financing are examples of cash flow loans. Is debt financing a loan? Yes, loans are the most common forms of debt financing. Is debt financing good or bad? Debt financing can be both good and bad. If a company can use debt to stimulate growth, it is a good option. However, the company must be sure that it can meet its obligations regarding payments to creditors. A company should use the cost of capital to decide what type of financing it should choose. The bottom line, most companies will need some form of debt financing. Additional funds allow companies to invest in the resources they need in order to grow. Small and new businesses, especially, need access to capital to buy equipment, machinery, supplies, inventory, and real estate. The main concern with debt financing is that the borrower must be sure that they have sufficient cash flow to pay the principal and interest obligations tied to the loan. Identify the components of debt and equity financing. Defining equity finance. Companies can use equity financing to raise money and slash or increase shareholder liquidity through an IPO. Key points. The equity or capital stock of a business entity represents the original capital paid into or invested in the business by its founders. Shares represent a fraction of ownership in a business. A business may declare different types or classes of shares, each having distinctive ownership rules, privileges, or share values. In finance, the cost of equity is the return, often expressed as a rate of return. A firm theoretically pays to its equity investors, each shareholders, to compensate for the risk they undertake by investing their capital. Key terms: preferred stock with a dividend, usually fixed, that is paid out of profits before any dividend can be paid on common stock, and that has priority to common stock in liquidation. Common stock: shares of an ownership interest in the equity of a corporation or other entity with limited liability entitled to dividends, with financial rights junior to preferred stock and liabilities. Par value: the amount or value listed on a bill, note, stamp, etc., the stated value or amount. Equity: the equity or capital stock of a business entity represents the original capital paid into or invested in the business by its founders. It serves as a security for the creditors of a business since it cannot be withdrawn to the detriment of the creditors. Stock is different from the property and the assets of a business, which may fluctuate in quantity and value. The stock of a business is divided into multiple shares, the total of which must be stated at the time of business formation. Given the total amount of money invested in the business, a share has a certain declared face value, commonly known as the par value of a share. The par value is the minimum amount of money that a business may issue and sell shares for in many jurisdictions, and it is the value represented as capital in the accounting of the business. Shares represent a fraction of ownership in a business. A business may declare different types or classes of shares, each having distinct ownership rules, privileges, or share values. Ownership of shares is documented by the issuance of a stock certificate. A stock certificate is a legal document that specifies the amount of shares owned by the shareholder and other specifics of the shares, such as the par value, if any, or the class of the shares. Stock typically takes the form of either common or preferred. As a unit of ownership, common stock typically carries voting rights that can be exercised in corporate decisions. Preferred stock differs from common stock in that it typically does not carry voting rights, but is legally entitled to receive a certain level of dividend payments before any dividends can be issued to other shareholders. Financing through equity. The owners of a private company may want additional capital to invest in new projects within the company. They may also simply wish to reduce their holding, freeing up capital for their own private use. They can achieve these goals by selling shares in the company to the general public through a sale on a stock exchange. This process is called an initial public offering or IPO. By selling shares, they can sell part or all of the company to many part owners. The purchase of one share entitles the owner of that share to literally share in the ownership of the company, a fraction of the decision-making power, and potentially a fraction of the profits, which the company may issue as dividends. Public companies may issue additional shares, thus diluting current equity holders, to raise money to fund operations or capital investments. Financing a company through the sale of stock in a company is known as equity financing. Alternatively, debt financing, for example issuing bonds, can be done to avoid giving up shares of ownership of the company. Unofficial financing, known as trade financing, usually provides the major part of a company's working capital, day-to-day operational needs. Cost of equity. In finance, the cost of equity is the return, often expressed as a rate of return, a firm theoretically pays to its equity investors, shareholders, to compensate for the risk they undertake by investing their capital. Firms need to acquire capital from others to operate and grow. Individuals and organizations who are willing to provide their funds to others naturally desire to be rewarded. Just as landlords seek rents on their property, capital providers seek returns on their funds, which must be commensurate with the risk undertaken. Firms obtain capital from two kinds of sources: lenders and equity investors. From the perspective of capital providers, lenders seek to be rewarded with interest, and equity investors seek dividends and or appreciation in the value of their investment, capital gain. From a firm's perspective, they must pay for the capital it obtains from others, which is called its cost of capital. Such costs are separated into a firm's cost of debt and cost of equity and attributed to these two kinds of capital sources. While a firm's present cost of debt is relatively easy to determine from observation of interest rates in the capital markets, its current cost of equity is unobservable and must be estimated. According to finance theory, as a firm's risk increases/decreases, its cost of capital increases/decreases. This theory is linked to observation of human behavior and logic. Capital providers expect reward for offering their funds to others. Such providers are usually rational and prudent, preferring safety over risk. They naturally require an extra reward as an incentive to place their capital in a riskier investment instead of a safer one. If an investment's risk increases, capital providers demand higher returns, or they will place their capital elsewhere. Summarize the role of debt and equity financing in determining organizational growth. Defining long-term debt. Long-term debt is a means of financing that allows firms access to capital without diluting equity. Capital and interest is paid off over time. Video. Understanding debt versus equity financing with Bond Street. View the Understanding Debt versus Equity Financing with Bond Street video. This video provides a clear explanation on the role of debt and equity financing in determining organizational growth. Understanding debt versus equity financing with Bond Street key points. Debt financing takes the form of loans that must be repaid by the borrower over a specified period of time, usually with interest. Generally, debt financing is most appropriate for firms who are in the startup phase or have progressed to the maturity phase. For young companies, debt financing usually takes the form of bank loans, while mature companies may issue bonds. When investors buy a corporate bond or the bank loans to a small business, they must have faith that the company will have the means to repay them. Riskier investments will require compensation for the lender in the form of higher interest rates. Bonds may be an attractive alternative to getting bank loans or issuing stock because it can have less restrictive loan terms and better interest rates than loans, and it doesn't dilute equity or ownership as stock does. It also has considerable corporate tax advantages. Costs of debt financing include bankruptcy costs, in the event of inability to cover payments to lenders, and increased uncertainty about future financing needs. Key terms: bond, a documentary obligation to pay a sum or to perform a contract, a debenture. Debt, money that the borrowing entity owes or is required to pay to a lender. Debt financing, in the most basic terms, debt financing takes the form of short-term or long-term loans that must be repaid over a specified period of time, usually with interest. Money is borrowed, and usually the borrower-debtor gives the lender, creditor, a promissory note that obligates the debtor to pay back a certain defined amount at a particular and defined time in the future. Bank loans as a means of financing. A promissory note dating to 1926 from the Imperial Bank of India, Rangoon, Burma, for 20,000 rupees, plus interest. With debt financing, the creditor's return is fixed as the agreed-upon interest rate for the debt, which varies depending on the perceived riskiness of the debtor. Debt financing usually takes the form of bank loans or bonds. Bonds. Bonds are a debt security under which the issuer owes the holders a debt. Depending on the terms of the bond issuer is obliged to pay the bondholder's interest and or to repay the principal, also known as nominal, par, or face amount. Most corporate bonds are fixed-rate bonds, meaning that the interest rate stays the same until maturity. Some use floating rates to determine the exact interest rate paid to bondholders. The interest rate paid on these varies depending on some index, such as the IBOR. Other corporate bonds, called zero coupons, make no regular interest payments at all. but investors still receive returns because these bonds are originally sold at a discount and then are redeemed at par value upon maturity. Interest rate. The interest that the firm will pay ultimately comes down to one factor: at what rate will investors believe the bonds are a good investment? Riskier investments will require compensation for the lender in the form of higher interest rates. Indicators for riskiness can include individual credit histories for a bank loan or bond rating by a credit rating company for corporate bonds. The difference in yield reflects the higher probability of default and liquidity and risk premium. Capital structure theory. The actual effect of the firm's capital structure on firm value is a contested topic in financial theory. See Miller-Modigliani theorem. From a tax perspective, debt financing may have some advantages over equity financing for both investors and the firm. Under a majority of taxation systems around the world, firms are subject to corporate tax and individuals to income tax, leading to double taxation of dividends if the firm is financed through issuing stock. For example, a firm that earns $100 in profits in the U.S. would have to pay around $30 in taxes. If it then distributes these profits to its owners as dividends, then the owners in turn pay taxes on this income, say $20 on the $70 of dividends. The $100 of profits turn into $50 of investor income. If, instead, the firm finances with debt, then, assuming the firm owes $100 of interest to investors, its profits are now zero. Investors now pay taxes on their interest income, say $30. This implies for $100 of profits before taxes, investors got $70. The firm also benefits considerably, as interest payments can be deducted from the firm's taxable income, while dividends and share repurchases cannot be deducted. It is also postulated that debt makes management more disciplined, forcing them to work harder to ensure that they will make enough to cover their interest payments. These benefits are applicable to both bonds and bank loans. However, costs of debt can outweigh these benefits, depending on the firm. In the event of inability to repay debts, firms go into bankruptcy, which is a costly process in itself. Furthermore, the more debt a firm takes on, the more uncertainty it will have about future financing needs. If a firm is already taking on a considerable amount of debt today, where will it get financing for its operations in the future? Should a company issue debt or equity? Businesses often need external money to maintain their operations and invest in future growth. There are two types of capital that can be raised: debt and equity. Debt capital. Debt financing is capital acquired through the borrowing of funds to be repaid at a later date. Common types of debt are loans and credit. The benefit of debt financing is that it allows a business to leverage a small amount of money into a much larger sum, enabling more rapid growth than might otherwise be possible. In addition, payments on debt are generally tax deductible. 1. The downside of debt financing is that lenders require the payment of interest, meaning the total amount repaid exceeds the initial sum. Also, payments on debt must be made regardless of business revenue. For smaller or newer businesses, this can be especially dangerous. Equity capital. Equity financing refers to funds generated by the sale of stock. The main benefit of equity financing is that funds need not be repaid. However, equity financing is not the no-strings-attached solution it may seem. Shareholders purchase stock with the understanding that they then own a small stake in the business. The business is then beholden to shareholders and must generate consistent profits in order to maintain a healthy stock valuation and pay dividends. Since equity financing is a greater risk to the investor than debt financing is to the lender, the cost of equity is often higher than the cost of debt. How to choose between debt and equity. The amount of money that is required to obtain capital from different sources, called cost of capital, is crucial in determining a company's optimal capital structure. Cost of capital is expressed either as a percentage or as a dollar amount, depending on the context. The cost of debt capital is represented by the interest rate required by the lender. A $100,000 loan with an interest rate of 6% has a cost of capital of 6% and a total cost of capital of $6,000. However, because payments on debt are tax deductible, many cost of debt calculations take into account the corporate tax rate. Assuming the tax rate is 30%, the above loan would have an after-tax cost of capital of 4.2%. Cost of equity calculations. The cost of equity financing requires a rather straightforward calculation involving the capital asset pricing model, or CAPM. CAPM equals risk-free rate, company's beta X risk premium. CAPM equals company's beta X risk premium, risk-free rate, by taking into account the returns generated by the larger market, as well as the individual stock's relative performance, represented by beta. The cost of equity calculation reflects the percentage of each invested dollar that shareholders expect in returns. Finding the mix of debt and equity financing that yields the best funding at the lowest cost is a basic tenet of any prudent business strategy. To compare different capital structures, corporate accountants use a formula called the weighted average cost of capital, or WACC. The WACC multiplies the percentage costs of debt, after accounting for the corporate tax rate, and equity under each proposed financing plan by a weight equal to the proportion of total capital represented by each capital type. This allows businesses to determine which levels of debt and equity financing are most cost-effective. Summarize the role of debt and equity financing in determining organizational growth. Since equity financing is a greater risk to the investor than debt financing is to the lender, the cost of equity is often higher than the cost of debt. How to choose between debt and equity. The amount of money that is required to obtain capital from different sources, called cost of capital, is crucial in determining a company's optimal capital structure. Cost of capital is expressed either as a percentage or as a dollar amount, depending on the context. The cost of debt capital is represented by the interest rate required by the lender. A $100,000 loan with an interest rate of 6% has a cost of capital of 6% and a total cost of capital of $6,000. However, because payments on debt are tax deductible, many cost of debt calculations take into account the corporate tax rate. Assuming the tax rate is 30%, the above loan would have an after-tax cost of capital of 4.2%. Cost of equity calculations. The cost of equity financing requires a rather straightforward calculation involving the capital asset pricing model, or CAPM. CAPM equals risk-free rate, company's beta X risk premium. CAPM equals company's beta X risk premium, risk-free rate, by taking into account the returns generated by the larger market, as well as the individual stock's relative performance, represented by beta. The cost of equity calculation reflects the percentage of each invested dollar that shareholders expect in returns. Finding the mix of debt and equity financing that yields the best funding at the lowest cost is a basic tenet of any prudent business strategy. To compare different capital structures, corporate accountants use a formula called the weighted average cost of capital, or WACC. The WACC multiplies the percentage costs of debt, after accounting for the corporate tax rate, and equity under each proposed financing plan by a weight equal to the proportion of total capital represented by each capital type. This allows businesses to determine which levels of debt and equity financing are most cost-effective. Summarize the role of debt and equity financing in determining organizational growth. Defining preferred stock. Firms may raise capital by receiving funds from investors in exchange for equity stakes in the form of common and preferred stock. Key points. Firms using equity financing gain financial capital from investors in exchange for ownership stakes in the firm in the form of common and preferred stocks. The main advantage of equity financing is the lack of an obligation to pay back all investors in the event of poor company performance, while the main disadvantage is diminished control and business autonomy. In the event of liquidation and dividend payments, preferred stock has priority claims to assets. Common stockholders must wait until all preferred stockholders have been paid in full. In the event of bankruptcy, common stock investors receive any remaining funds after bondholders, creditors, including employees, and preferred stockholders are paid. Common stockholders often have voting rights, exercising some measure of control over company board elections and corporate policy, while preferred stockholders usually lack these rights. Preferred stock is divided into a number of subcategories, including cumulative preferred stock, non-cumulative preferred stock, participating preferred stock, and convertible preferred stock. Key terms: common stock. shares of an ownership interest in the equity of a corporation or other entity with limited liability. Holders of this type of stock are entitled to dividends. Importantly, the financial rights for holders of this type of stock are junior to preferred stock and liabilities. Preferred stock, stock with a dividend, usually fixed, that is paid out of profits before any dividend can be paid on common stock. It also has priority to common stock in liquidation. Introduction: equity financing. Equity financing occurs when ownership stakes in a particular firm are exchanged for financial capital from investors. These investors may be all types of people, from friends and family of the business to wealthy angel investors to venture capitalists. The main advantage of equity financing is that the business is not obligated to repay anything, since the individual investors are assuming a certain amount of risk in return for the possibility of making money in the future. However, because equity financing involves trading funds for ownership in a company, these new investors do gain some decision-making power in the company, and the managers lose some autonomy. They are usually financed through debt, but may find investors who are willing to take on risk if projected growth is high. In the growth stage, a firm's initial EFN is high relative to its current value. It needs significant funds for growth. It can be financed through venture capital or issuing equity. Growth eventually slows and the firm enters the mature stage. These firms can be financed by equity or debt. If they have no new projects, EFN is relatively low. The firm may go into decline as their product becomes obsolete or a competitor outperforms them. In this case, they have very low external financing needs. Key terms: debt, money that the borrowing entity owes or is required to pay to a lender. External financing needs, additional funds needed from sources outside the firm in order to support firm operations. Venture capital, money invested in an innovative enterprise in which both the potential for profit and the risk of loss are considerable. Firm life cycle, most businesses pass through a series of well-defined stages based on their level of development. Churchill and Lewis, 1983, identified that all businesses vary greatly in size and potentiality for growth. However, they all experience common problems that arise at similar stages of their development. From these observations came the four-stage life cycle of the firm. Methods of obtaining financial capital may be more or less suitable for a firm, depending on the current stage of its life cycle. Firm life cycle. Firms progress through stages of development, indicated by their changing profits over time. In the first stage, a new company begins with the seed of an idea. Its external financing needs, EFN, are high since it needs money to develop, lacks retained earnings. These young firms are frequently financed through debt, acquiring loans from banks and acquaintances. They may also acquire seed money, a form of securities offering in which an investor, usually friends, family, or angel investors, purchases part of a business. The source of the financing may depend on the perceived riskiness and growth of the business. Growth. After the firm is able to acquire external funding and develop its product/service, it enters the growth phase. Once a company has a successful strategy, it attempts to offer its products or services to potential customers, expanding first to other states and regions, and then often internationally and globally. Successful companies can turn in increasing earnings year after year, evidenced by the increasingly steep slope in the diagram. Firms may face an increase in competitors. In the growth stage, a firm's initial EFN is high relative to its current value. It needs significant funds for growth. If it fits the specifications for venture capital, high growth potential, innovative product, a VC firm may agree to finance the firm. It may also raise capital through equity financing. As it progresses through the growth stage, earnings begin to increase less rapidly. At some point, the company may decide to go public, offering its stock to the general public on a security exchange as a means of equity financing. Maturity. Eventually, all possible customers have the product or service. They may still buy parts or replace their product with newer models, etc., but growth slows. This is the mature stage of a company's development. If the firm has no new projects in the works, their EFN is quite low and internal funding is high. In fact, the firm may have so much in retained earnings that they cannot put all of it to productive use. They can choose to finance operations by issuing bonds and equity. Decline. When the firm has reached the final stage, sales can stagnate or decline due to replacement by a better product or competitor. EFN declines further. They may choose to retire debt or repurchase stock, as significant external financing is no longer necessary. Contrast components of debt to equity financing. Defining long-term financing. Long-term financing is generally for assets and projects, and short-term financing is typically for continuing operations. Key points. Management must match long-term financing or short-term financing mix to the assets being financed in terms of both timing and cash flow. Long-term financing includes equity issued, corporate bond, capital notes, and so on. Short-term financing includes commercial papers, promissory notes, asset-based loans, repurchase agreements, letters of credit, and so on. Key terms. Accounts receivable. Accounts receivable, also known as debtors, is money owed to a business by its clients, customers, and shown on its balance sheet as an asset. Call option. A call option, often simply labeled a call, is a financial contract between two parties, the buyer and the seller of this type of option. The buyer of the call option has the right, but not the obligation, to buy an agreed quantity of a particular commodity or financial instrument, the underlying, from the seller of the option at a certain time, the expiration date, for a certain price, the strike price. Swap. In finance, a swap is a derivative in which counterparties exchange cash flows of one party's financial instrument for those of the other party's financial instrument. Long-term financing. Achieving the goals of corporate finance requires appropriate financing of any corporate investment. The sources of financing are, generically, capital that is self-generated by the firm and capital from external funders, obtained by issuing new debt and equity. Management must attempt to match the long-term or short-term financing mix to the assets being financed as closely as possible in terms of both timing and cash flows. Financing. To manage business often requires long-term and short-term financing. Businesses need long-term financing for acquiring new equipment, R&D, cash flow enhancement, and company expansion. Major methods for long-term financing are as follows. Equity financing. This includes preferred stocks and common stocks, and is less risky with respect to cash flow commitments. However, it does result in a dilution of share ownership, control, and earnings. The cost of equity is also typically higher than the cost of debt, which is, additionally, a deductible expense, and so equity financing may result in an increased hurdle rate, which may offset any reduction in cash flow risk. Corporate bond. A corporate bond is a bond issued by a corporation to raise money effectively so as to expand its business. The term is usually applied to longer-term debt instruments, generally with a maturity date falling at least a year after their issue date. Some corporate bonds have an embedded call option that allows the issuer to redeem the debt before its maturity date. Other bonds, known as convertible bonds, allow investors to convert the bond into equity. Capital notes. Capital notes are a form of convertible security exercisable into shares. They are equity vehicles. Capital notes are similar to warrants, except that they often do not have an expiration date or an exercise price. Hence, the entire consideration the company expects to receive for its future issue of shares is paid when the capital note is issued. Many times, capital notes are issued in connection with a debt for equity swap restructuring. Instead of issuing the shares that replace debt in the present, the company gives creditors convertible securities capital notes, so the dilution will occur later. Short-term financing. Short-term financing can be used over a period of up to a year to help corporations increase inventory orders, payrolls, and daily supplies. Short-term financing includes the following financial instruments. Commercial paper. This is an unsecured promissory note with a fixed maturity of 1 to 364 days in the global money market. It is issued by large corporations to get financing to meet short-term debt obligations. It is only backed by an issuing bank or corporation's promise to pay the face amount on the maturity date specified on the note. Since it is not backed by collateral, only firms with excellent credit ratings from a recognized rating agency will be able to sell their commercial paper at a reasonable price. Asset-backed commercial paper, ABCP, is a form of commercial paper that is collateralized by other financial assets. ABCP is typically a short-term instrument that matures between 1 and 180 days from issuance and is typically issued by a bank or other financial institution. Promissory note. This is a negotiable instrument, wherein one party, the maker or issuer, makes an unconditional promise in writing to pay a determinate sum of money to the other, the payee, either at a fixed or determinable future time or on demand of the payee, under specific terms. Asset-based loan. This type of loan, often short-term, is secured by a company's assets, real estate, accounts receivable, /R, inventory and equipment are typical assets used to back the loan. The loan may be backed by a single category of assets or a combination of assets, for instance, a combination of /R and equipment. Repurchase agreements. These are short-term loans, normally for less than 2 weeks and frequently for just 1 day, arranged by selling securities to an investor with an agreement to repurchase them at a fixed price on a fixed date. Letter of credit. This is a document that a financial institution or similar party issues to a seller of goods or services, which provides that the issuer will pay the seller for goods or services the seller delivers to a third-party buyer. The issuer then seeks reimbursement from the buyer or from the buyer's bank. The document serves essentially as a guarantee to the seller that it will be paid by the issuer of the letter of credit, regardless of whether the buyer ultimately fails to pay. Difference between debt and equity. Capital is the basic requirement of every business organization to fulfill the long-term and short-term financial needs. To raise capital, an enterprise either used owned sources or borrowed ones. Owned capital can be in the form of equity, whereas borrowed capital refers to the company's owed funds or, say, debt. Equity refers to the stock, indicating the ownership interest in the company. On the contrary, debt is the sum of money borrowed by the company from bank or external parties that required to be repaid after certain years, along with interest. Almost all the beginners suffer from this confusion that whether the debt financing would be better or equity financing is suitable. So here, we will discuss the difference between debt and equity financing to help you understand which one is appropriate for your business type. Comparison chart. Definition of debt. Money raised by the company in the form of borrowed capital is known as debt. It represents that the company owes money towards another person or entity. They are the cheapest source of finance as their cost of capital is lower than the cost of equity and preference shares. Funds raised through debt financing are to be repaid after the expiry of the specific term. Debt can be in the form of term loans, debentures, or bonds. Term loans are obtained from financial institutions or banks, while debentures and bonds are issued to the general public. Credit rating is mandatory for issuing debentures publicly. They carry fixed interest, which requires timely payments. The interest is tax-deductible in nature, so the benefit of tax is also available. However, the presence of debt in the capital structure of a company can lead to financial leverage. Debt can be secured or unsecured. Secured debt requires pledging of an asset as security so that if the money is not paid back within a reasonable time, the lender can forfeit the asset and recover the money. In the case of unsecured debt, there is no obligation to pledge an asset for getting the funds. Definition of equity. In finance, equity refers to the net worth of the company. It is the source of permanent capital. It is the owner's funds which are divided into some shares. By investing in equity, an investor gets an equal portion of ownership in the company in which he has invested his money. The investment in equity costs higher than investing in debt. Equity comprises of ordinary shares, preference shares, and reserve and surplus. The dividend is to be paid to the equity holders as a return on their investment. The dividend on ordinary shares, equity shares, is neither fixed nor periodic, whereas preference shares enjoy fixed returns on their investment, but they are also irregular in nature. Although the dividend is not tax-deductible in nature, investment in equity shares is the risky one, as in the event of winding up of the company. They will be paid at the end after the debt of all the other stakeholders is discharged. There are no committed payments in equity shareholders. Either payment of dividend is voluntary. Apart from that, equity shareholders will be paid off only at the time of liquidation, while the preference shares are redeemed after a specific period. Key differences between debt and equity. The difference between debt and equity capital are represented in detail in the following points. Debt is the company's liability, which needs to be paid off after a specific period. Money raised by the company by issuing shares to the general public, which can be kept for a long period, is known as equity. Debt is the borrowed fund, while equity is owned fund. Debt reflects money owed by the company towards another person or entity. Conversely, equity reflects the capital owned by the company. Debt can be kept for a limited period and should be repaid back after the expiry of that term. On the other hand, equity can be kept for a long period. Debt holders are the creditors, whereas equity holders are the owners of the company. Debt carries low risk as compared to equity. Debt can be in the form of term loans, debentures, and bonds, but equity can be in the form of shares and stock. Return on debt is known as interest, which is a charge against profit. In contrast to the return on equity is called as a dividend, which is an appropriation of profit. Return on debt is fixed and regular, but it is just opposite in the case of return on equity. Debt can be secured or unsecured, whereas equity is always unsecured. Conclusion: it is essential for all the companies to maintain a balance between debt and equity funds. The ideal debt-equity ratio is 2 to 1. Equity should always be twice of the debt. Only then it can be assumed that the company can cover its losses effectively. Why do debt-to-equity ratios vary from industry to industry? Some of the major reasons why the debt-to-equity D/E ratio varies significantly from one industry to another, and even between companies within an industry, include different capital intensity levels between industries and whether the nature of the business makes carrying a high level of debt easier to manage. The industries that typically have the highest D/E ratios include utilities and financial services. Wholesalers and service industries are among those with the lowest. Key takey 8 The debt-to-equity D/E ratio measures how much of a business's operations are financed through debt versus equity. A higher D/E ratio indicates that a company is financed more by debt than it is by its wholly owned funds. Depending on the industry, a high D/E ratio can indicate a company that is riskier. D/E ratios vary. D/E ratios vary across industries because some industries are more capital intensive than others. The financial sector has one of the highest D/E ratios, but this is not indicative of high risk, just the nature of the business. The debt-to-equity ratio. The D/E ratio is a basic metric used to assess a company's financial situation. It indicates the relative proportion of equity and debt that a company uses to finance its assets and operations. The ratio reveals the amount of financial leverage a company uses. The formula is total liabilities divided by total shareholders' equity. Why debt-to-equity ratios vary. One of the major reasons why D/E ratios vary is the capital-intensive nature of the industry. Capital-intensive industries, such as oil and gas refining or telecommunications, require significant financial resources and large amounts of money to produce goods or services. For example, the telecommunications industry has to make very substantial investments in infrastructure, installing thousands of miles of cables to provide customers with service. Beyond that initial capital expenditure, necessary maintenance, upgrades, and expansion of service areas require additional major capital expenditures. Industries such as telecommunications or utilities require a company to make a large financial commitment before delivering its first good or service and generating any revenue. If a company is in decline, then a high D/E ratio is of concern. Conversely, if a company is on the rise, a high D/E ratio might be necessary for growth. Another reason why D/E ratios vary is based upon whether the nature of the business means that it can manage a high level of debt. For example, utility companies bring in a stable amount of income. Demand for their services remains relatively constant regardless of overall economic conditions. Also, most public utilities operate as virtual monopolies in the regions where they do business, so they do not have to worry about being cut out of the marketplace by a competitor. Such companies can carry larger amounts of debt with less genuine risk exposure than a business with revenues that are more subject to fluctuation in accord with the overall health of the economy. The D/E ratio is a key metric used to examine a company's overall financial soundness. An increasing ratio over time indicates that a company is financing its operations increasingly through creditors rather than through employing its resources, and that it has a relatively higher fixed interest rate charge burden on its assets. Investors typically prefer companies with low D/E ratios as it means their interests are better protected in the event of a liquidation. Extraordinarily high ratios are unattractive to lenders and may make it more difficult to obtain additional financing. A low D/E. A low D/E ratio is sometimes not desirable as it can indicate that a company is not using its assets efficiently. The average D/E ratio among S&P 500 companies is approximately 1.5. A ratio lower than 1 is considered favorable, since that indicates a company is relying more on equity than on debt to finance its operating costs. Ratios higher than 2 are generally unfavorable, although industry and similar company averages have to be considered in the evaluation. The D/E ratio can also indicate how generally successful a company is at attracting equity investors. The bottom line: the D/E ratio measures the proportion of how a company finances its operations with debt versus equity. Each industry has a different parameter of what constitutes a good or bad D/E ratio based on their capital requirements and revenue-generating capabilities. Generally, the lower the D/E ratio the better, as it indicates a company does not have significant debt burdens and generates enough income through its core operations to run its business. Differentiate between internal versus external financing. Business implies a commercial activity of producing and distributing goods and services to final consumers for a profit. To undertake various business activities, an entity requires money, and thus, finance is said to be the spine of business that keeps it going. The capital brought in to the business by the proprietor is not sufficient to fulfill the financial needs, and so she looks for new ways to fulfill fixed capital and working capital needs. Based on the source of generation, it is classified as internal and external sources, wherein former covers those means which are generated within the business. Difference between internal and external sources of finance. Internal and external sources of finance business implies a commercial activity of producing and distributing goods and services to final consumers for a profit. To undertake various business activities, an entity requires money, and thus, finance is said to be the spine of business that keeps it going. The capital brought in to the business by the proprietor is not sufficient to fulfill the financial needs, and so she looks for new ways to fulfill fixed capital and working capital needs. Based on the source of generation, it is classified as internal and external sources, wherein former covers those means which are generated within the business. Conversely, the latter implies the sources of funds that are outside the business, like finance provided by investors, lending institutions, etc. A firm can raise funds from different sources, wherein each source has distinct features. One should understand the basic features of the sources of finance so as to identify the best available source to meet out financial requirements. Here, in the given article, we are going to talk about the differences between internal and external sources of finance. Definition of internal sources of finance. In business, internal sources of finance delineate the funds raised from existing assets and day-to-day operations of the concern. It aims at increasing the cash generated from regular business activities. For this purpose, evaluation and control of costs are made, along with reviewing the budget. Moreover, the credit terms with customers are verified so as to effectively manage the collection of receivables. Internal sources of finance include selling of surplus inventories, plowing back of profit, accelerating collection of receivables, and so on. Definition of external sources of finance. External sources of finance refer to the cash flows generated from outside sources of the organization, whether from private means or from the financial market. In external financing, the funds are arranged from the sources outside the business. There are two types of external sources of finance: long-term source of finance and short-term sources of finance. Further, on the basis of nature, they can be classified as debt financing. The source of finance wherein fixed payment has to be made to the lenders is debt financing. It includes bank loans, corporate bonds, leasing, commercial paper, trade credit, debentures, equity financing, Equity is the major source of finance for most of the companies, which indicate the share in the ownership of the firm and the interest of the shareholders. The firms raise capital by selling its shares to the investors. It includes ordinary shares, preference shares. Key differences between internal and external sources of finance. The points given below explain the difference between internal and external sources of finance. When the cash flows are generated from sources inside the organization, it is known as internal sources of finance. On the other hand, when the funds are raised from the sources external to the organization, whether from private sources or from the financial market, it is known as external sources of finance. Internal sources of finance include sale of stock, sale of fixed assets, retained earnings, and debt collection. In contrast, external sources of finance include financial institutions, loan from banks, preference shares, debenture, public deposits, lease financing, commercial paper, trade credit, factoring, etc. While internal sources of finance are economical, external sources of finance are expensive. Internal sources of finance do not require collateral for raising funds. Conversely, assets are sometimes mortgaged as security so as to raise funds from external sources. Amount raised from internal sources is less, and they can be put to a limited number of uses. On the contrary, large amounts can be raised from external sources, which have various uses. Conclusion: there are a number of factors which influence the owner's decision, which determines the source of fund to be chosen. Such factors include a time period for which funds are required, the purpose of raising finance, and the total funds required by the firm. Outline the key features of common and preferred stock. Defining common stock. Common stock is a form of ownership and equity, different from preferred stock, that still earns rights of ownership for its shareholders. Key points. Common stock is a form of equity ownership. It is a type of security that is also known as a voting share or an ordinary share. Common stock shareholders will not receive assets after bankruptcy unless the bondholders, other creditors, and preferred shareholders are paid first. Common shareholders also do not get dividends unless preferred shareholders receive them first. Common shareholders do receive voting rights. Some shareholders may also be able to exercise preemptive rights. Key terms: common stock. Common stock is a form of equity and type of security. Common stock shareholders are at the bottom of the line when it comes to dividends and receiving compensation in the case of bankruptcy. Equity: the residual claim or interest to investors in assets after all liabilities are paid. If liability exceeds assets, negative equity exists and can be purchased through stock. Dividend: dividends are payments made by a corporation to its shareholder members. Common stock is a form of corporate equity ownership, which is a type of security. The terms voting share or ordinary share are also used in other parts of the world. Common stock is used primarily in the United States. It is called common to distinguish it from preferred stock. If both types of stock exist, common stockholders cannot be paid dividends until all preferred stock dividends, including payments in arrears, are paid in full. Should bankruptcy occur, common stock shareholders receive any remaining funds after the bondholders, creditors, including employees, and preferred stockholders. Such shareholders usually receive nothing in the case of company liquidation. New York Stock Exchange. Stocks can be bought and sold on exchanges, like the New York Stock Exchange shown above. While common stockholders are generally last in line among other creditors to receive assets should the business in question go bankrupt, common shares do tend to perform better than preferred shares over time. Also, common stock usually carries the right to vote on certain matters. These matters include, but are not limited to, deciding who gets to sit on the board of directors of the company. However, a company can have both a voting and non-voting class of common stock. Common shareholders do not get guaranteed dividends, so their returns can be uncertain. It must be remembered that preferred stock generally does not carry voting rights. Holders of common stock are able to influence the corporation through votes on establishing corporate objectives and policy, stock splits, and electing the company's board of directors. Some holders of common stock also receive preemptive rights, which enable them to retain their proportional ownership in a company should it issue another stock offering. Proxy voting gives fund shareholders a say. As a shareholder, you are entitled to vote by proxy on the big issues that impact a company's financials, even if you can't attend the meeting in person. During proxy season at the beginning of each year, in advance of the annual general meeting, AGM, of a company or mutual fund, shareholders will receive a package in the mail containing a variety of documents that report financial data and operations results and announce important issues, such as proposals for changes to the company's share structure or mergers and acquisitions. These are all matters that shareholders or unit holders, the true owners of the company or mutual fund, will vote on at the general meeting. If, however, shareholders are not able to attend an annual or special meeting, they can vote on proposals by means of a proxy, one of the documents included in the pre-meeting mailing package. A proxy vote is a ballot cast by one person or firm on behalf of a shareholder of a corporation who may not be able to attend a shareholder meeting, or who otherwise desires not to vote on an issue prior to a company's annual meeting. Eligible shareholders may receive voting and proxy information in advance of their shareholder vote. Rather than physically attending the shareholder meeting, investors may elect someone else, such as a member of the company's management team, to vote in their place. The purpose of proxy voting. Shareholder voting is the primary means by which shareholders can influence the company's or mutual fund's operations, its corporate governance, and even activities of social responsibility that may fall outside of financial considerations. It is therefore very important for shareholders to participate in the voting and make their decisions based on a full understanding of the information and legal documentation presented to them. At shareholder meetings, investors with common shares or mutual fund units typically receive one vote per share or unit, unless they own shares carrying additional voting provisions. The votes of shareholders who are absent from a meeting and have not used a proxy card bearing their signature are considered to have abstained. They count neither for nor against any proposal tabled at the meeting. But proxy voting allows shareholders to vote when they can't attend a shareholder meeting, so investors are quite literally able to own and vote on equities in companies and mutual funds that might be located and registered clear across the globe. In the Internet age, investors can not only buy and sell stocks online, but also vote their proxy statements. The entire documentation delivery process can be electronically automated. Official documentation is delivered to shareholders in electronic form, and then they log onto the system with a control number or personal identification number and vote for or against the resolutions presented. Proxy voting guidelines. The Internet also greatly assists shareholders in researching their decisions. Numerous institutional investors now post their voting decisions online prior to the meeting date, giving individual investors a chance to see where the large institutional shareholders stand on issues. These same institutions may also provide extensive explanations of their decisions by posting their proxy voting guidelines. For example, institutions may cast their votes on criteria of long-term value, corporate accountability, responsibility, sustainability, and so on. The most proactive of institutional investors play a sort of champion role in keeping directors accountable for the resolutions that are introduced at important meetings. Not only will the institution establish its model proxy voting guidelines, but if a decision is initially unclear, it will seek additional information from the company itself. For example, an institution might contact management directly to discuss a specific proposal, suggest modifications to the nature of the proposal, or, in extreme cases, urge the withdrawal of the proposal in its entirety. Such influence is generally held only by powerful institutional investors, making the institution's role in the proxy voting process invaluable. Innovations to the proxy voting system. In the wake of much publicized corporate scandals perpetrated by the management and directors of various publicly traded companies over the years, more consideration has been given to revisions of the proxy voting system, most significantly, allowing shareholders to take an active role in introducing resolutions to the proxy. Today, any shareholder or group of shareholders who has owned at least $2,000 or 1% of a company's stock continuously for at least a year may introduce a proposal. These proposals are often termed direct proxy access and focus most prominently on allowing shareholders to nominate director candidates. On the one hand, this brings fresh perspectives to the board of directors, but on the other hand, lack of experience, among other factors, could cause shareholders to nominate directors who are truly inappropriate for directorship. The bottom line: proxy voting is often the sole means by which investors can have a say in the business operations and societal activities of their company or mutual fund. Shareholders need not attend an important meeting in person, but they certainly must make the effort to read and understand legal resolutions and use all available resources to make an educated vote based on their best knowledge and information. Explain the difference between common and preferred stock. Correlate the features of common and preferred stock to real-world business scenarios. Defining preferred stock. Preferred stock usually carries no voting rights, but may carry a dividend, have priority over common stock upon liquidation and slash or have other benefits. Key points. Preferred stock is a security which has characteristics of both equity and debt securities. Preferred stock shareholders have rights to dividends and assets in the case of bankruptcy before common stock shareholders. Preferred stockholders have a number of rights which will vary based on the business entity, but generally do not carry voting rights. Key terms. Preferred stock. Preferred stock is an equity security that has the properties of both an equity and debt instrument and is higher ranking than common stock. Bond. A bond is an instrument of indebtedness of the bond issuers toward the bondholders. Preferred stock. Preferred stock, also called preferred shares, preference shares, or simply preferred, is an equity security with properties of both an equity and a debt instrument, and is generally considered a hybrid instrument. It is senior, higher ranking, to common stock, but subordinate to bonds in terms of claim or rights to their share of the assets of the company. In other words, in the case of liquidation or bankruptcy, preferred stock will have claim to assets before common stock, but after corporate bonds or other debt instruments. Preferred stock usually carries no voting rights, but may carry a dividend and may have priority over common stock in the payment of dividends and upon liquidation. The specific terms of owning preferred stock are specified in a certificate of designation. The features and rights which are generally associated with preferred stock are as follows: preference and dividends, preference and assets in the event of liquidation, convertibility to common stock, callability at the option of the corporation, non-voting rights. Similar to bonds, preferred stocks are rated by the major credit rating companies. Bond. Preferred stocks are considered a hybrid security with properties of both stocks and bonds, but are subordinate to bonds when it comes to rights of claim to company assets. The rating for preferreds is generally lower, since preferred dividends do not carry the same guarantees as interest payments from bonds, and they are junior to all creditors. Details with regards to the rights associated with preferred stock will vary with the business entity that issues the shares, and preferred stock can come in a number of different classes. Some examples are prior preferred stock, highest priority, preference preferred stock, convertible preferred stock, exchangeable for common stock, cumulative preferred stock, exchangeable preferred stock, participating preferred stock, puttable preferred stock, monthly income preferred stock, and non-cumulative preferred stock. What are some examples of preferred stock, and why do companies issue it? There are several reasons why a company chooses to offer preferred stock, all of which relate to the financial advantages that it provides. Companies offering preferred stock include Bank of America, BAC, Georgia Power Company, GPJA, and MetLife, MET. Preferred stock derives its name from the fact that it carries a higher privilege by almost every measure in relation to a company's common stock. Preferred stock owners are paid before common stock shareholders in the event of the company's liquidation. Preferred stockholders enjoy a fixed dividend that, while not absolutely guaranteed, is nonetheless considered essentially an obligation the company must pay. Preferred stockholders must be paid their due dividends before the company can distribute dividends to common stockholders. Preferred stock is sold at a par value and paid a regular dividend that is a percentage of par. Preferred stockholders do not typically have the voting rights that common stockholders do, but they may be granted special voting rights. Preferred stock provides a simpler means of raising substantial capital than the sale of common stock does. The par value at which companies offer preferred stock is often significantly higher than the common stock price. Because of tax advantages over retail investors, Institutions are more typically buyers of preferred stock than individual investors, and the larger amount of capital available to institutions enables them to purchase large blocks of preferred stock. This allows the company to obtain a substantial amount of equity more easily from each stock sale. Companies often offer preferred stock prior to offering common stock, when the company has not yet reached a level of success that would make it sufficiently attractive to large numbers of retail investors. The sale of preferred stock then provides the company with the capital necessary for growth. Preferred stock also offers companies some financial flexibility. Dividends owed to preferred stockholders can be deferred for a time if the company should experience some unexpected cash flow problems. The deferred dividends are essentially considered to be owed to the preferred stockholders, payable at some point in the future, but their deferral may be critical in helping a company bridge the gap over a period of financial difficulty. This is one way in which preferred stock is distinguished from bonds, since a company not making the interest payment due on a bond would ordinarily be considered to be in default and therefore risking bankruptcy. The nature of preferred stock provides another motive for companies to issue it. With its regular fixed dividend, preferred stock resembles bonds with regular interest payments. Like bonds, preferred stock is rated by credit agencies. However, unlike bonds that are classified as a debt liability, preferred stock is considered an equity asset. Issuing preferred stock provides a company with a means of obtaining capital without increasing the company's overall level of outstanding debt. This helps keep the company's debt to equity D/E ratio, an important leverage measure for investors and analysts, at a lower, more attractive level. Preferred stock is sometimes used by companies as a takeover defense by assigning very high liquidation value for the preferred shares that must be paid off if the company is taken over.